All right, traders and investors, welcome back. We have our final guest with us today, Mr. Russell Rhoads. He is a senior instructor with the Options Institutes at the Chicago Board of Options Exchange. Russell, welcome aboard. Thank you for coming in this morning.
Well, thanks for having me on again.
So, can you tell me a little bit more? Or can you elaborate on what the Options Institute is and what your role is there for the guests that perhaps missed you last time?
Oh, absolutely. The Options Institute, we're the oldest education division of any of the exchanges out there, and we do classes. I've spoken to a wide range of people, and it stretches from fifth graders. I actually taught fifth graders what an option was once, to some relatively high up people with the SEC that are trying to get a handle on what's going on in the option business. So we address a wide range of audiences, which keeps things interesting. There are four of us that are instructors here at the Options Institute: Marty Kearney, Jim Bittman, Peter Lusk, and myself. And if we were like college professors that had areas that we were specifically interested in, my area would be mostly VIX and some SPX, but mostly VIX.
Okay. Now, is the Options Institute, is this something that's open to the public, or how does this institute work?
Absolutely. If you go to the CBOE's website, of CBOE.com, there's an education tab. And also, if you just type CBOE.com/Learn Center, you get access to more free stuff than you know what to do with. And when I'm out and about and doing classes, one of the common questions I get is, what's a good book to get started with? And I tell people to save the money, and this comes from somebody that's written a couple of books. Save the money and start out using the website, because it's a good place to get started, and it's also free.
Now, the experience you guys have had building out the Options Institute, I'm sure it's changed a lot from what you guys first had released. Over the period that you've been involved, what if you had to say, what would be the biggest mistakes you've seen novice individuals make when they've started using options? As you guys have had to build out demand, what have you seen?
And it may even go along with the way that everybody goes about teaching options, but I have this kind of illustration that I use as far as having time on your side. And what I often say is that in order to, I believe that if anybody's going to make money in the options business, you need to be selling options in one way or another. Now, this doesn't mean only selling options, but always trying to mitigate time decay as much as you can. And what I do to illustrate it is I'll actually show a picture of Keith Richards from the 60s, and then I'll show a picture of what he looks like now, and I'll say that's somebody that did nothing but buy options. Time wasn't on his side, referring loosely to the Stones song. And then I'll use George Clooney as the example of somebody that has time on their side. And I say, every once in a while it's okay to be long options if you've got a good outlook or a solid outlook for where you think an underlying stock's going, and maybe in a low volatility environment. But more often than not, you should also be looking at a way to offset some of the time decay and try to have time on your side. So I think the biggest initial mistakes are that individuals get involved in options, and the first trade they do is buying an option contract. And I often say the best first option trade is a covered call, where maybe you have a stock that you would be willing to get out of at a higher price, and you sell a call option that would obligate you to sell the stock up at that price.
Okay, and then speaking to some exposure, and just switching over to VIX here, how's the new VIX contract doing? How's the volume in the open interest on it?
The volume on the VIX futures has, we're on track right now, because we had a couple of what I refer to as volatility events in early August to see record average daily volume in August. As of mid-year, both the VIX futures and the VIX options were on track to have a record average daily volume, and I think they were up around 20% respectively. Even though we've been in a low volatility environment, what we're seeing is more and more institutions look at call options on VIX as an equity portfolio hedge against what they often refer to as some sort of tail risk or a potential black swan event. And as long as VIX has remained at low levels like it has this year, buying call options as a hedge has been it's been a cheap insurance, and since you haven't really needed it quite yet, people continue to look at that as an alternative to SPX put options on an equity portfolio. So we continue to see increased institutional interest, even though we're in a low volatility environment.
Now, have you seen over the recent past here with the decline that's been going on in the broader market? Have you seen a pickup in the volume over at the CBOE for people that are taking options contracts or even VIX specifically?
Oh, absolutely. In fact, we did record VIX futures volume sometime during the first week of it was the day that the plane got shot down, but sometime I believe during the first week of August, we shattered the record as far as VIX futures volume goes. So every time, the interesting thing is every time there's some sort of a volatility event, we'll actually see volume pick up where it's either people panicking a little bit, or and putting on a quick hedge, or people that have some sort of position on that's going to benefit from a spike in volatility taking those positions off. So we tend to see an increase in volume around any what you would refer to as volatility event.
Okay, and now speaking to this volume and kind of the transformation that's happened because of automation within the markets, has there been, are your pits still active, or has a majority of the volume now moved to the screens where you now have guys that are just buying and trading these contracts, through their computer systems?
Well, when I take people, we trade SPX, we trade VIX, and then we trade equity options, and I include ETFs in the equity options space. And we still do have a trading floor with about 600 or 700 people down there. When I take people around, we go by all the posts where the equity options trade, and 99% of that volume is electronic, so there's really not a lot to see. But we have about 80 or 90 people in the VIX pit, and half of the VIX volume continue, and it depends on the day, but about 50% of volume is open outcry, and about 50% of the volume is electronic. And the reason we still have an open outcry pit, and actually an open outcry pit where more people are coming into the pit because of the increasing volume, is because institutions that want to do very, very large trades, and sometimes do very large trades in conjunction with something they may be doing in another derivative contract or even in the equity world, they want to get pricing, they want to get a price and substantial size from the pit. You can only get that really from an open outcry format. So we still have 50-50 there. In the S&P pit, about 95% of the SPX volume is still done in open outcry as well. When you see pictures from our floor, that it tends to be a strategic picture where you've got the S&P 500 pit in the background.
Yeah, I've seen those. I've noticed that. I'm kind of hoping that the pit could become like the new dark pool, where everybody's looking, the open outcry pit, where everybody's looking for stuff on the screen, and you can still fill something, from human to human in one of these less popular areas.
It's interesting you threw that dark pool reference out there, because if you look at what happened trading wise in SPX and VIX back on the flash crash, it's like the guys sat on their hands for just a few minutes and didn't, for lack of a better way to put it, they didn't bite when we had the big sell-off in the equity market. They're like, that's not correct. And that was one of those times where the people were smarter than the computers and realized that something wasn't quite right. And but you could actually see it in our volumes, where our volumes dropped off for a moment while everybody was waiting for the market to become normal again.
Yeah, I don't know how much data you might remember from this, but I was actually watching Money and Speed the other night from VPRO, and they were talking about, the crash that had happened in the E-minis and then the ETFs. Can you remember during the flash crash whether the guys that were in the pits were getting better, were they getting accurate data, or was it the same data everybody else seemed to be getting in the market that was delayed because of what happened between the SIP and direct feeds?
They were seeing in the SPX pit, they're seeing the same sort of quotes that everybody else gets, because the futures are across the street, and we're getting the equity prices from New York. But when the flash crash occurred, I was actually in a ballroom in front of about 200 people in Atlanta, and by the time my talk was over, I had about 40 people left. It was like a stream of people walking out while I was talking.
Wow.
So thank goodness I'm thick-skinned, because I had no clue what was going on at the time.
Yeah, there was really nothing that could be done at that moment in time. You just had to sit and kind of watch it.
Yeah.
Now, I guess we can wrap it up then. We'll take a look at. I kind of want to ask you about strategies. Are there any, aside from just outright buying of puts and calls, are there any other strategies that you're an advocate for in different market environments, such as like right now, where maybe we're trading sideways, or there's more fear, or if there's any sort of strategies that you like to use, or you see are popular amongst people that come through the Options Institute?
Well, in the VIX space, what's a pretty consistent trade that we see is as we see because we've stayed in a range, and if you think we're going to continue to stay in this low range in the low teens to the below the teens, you'll see a lot of straddle sellers, and they're selling straddles, but then they're buying upside protection because that's really where your risk is when when you're involved in the VIX market, because I think a lot of the traders take a look at VIX and historical price action in VIX, and they think that maybe the high 9s to 10 is somewhat of a floor. So, this is not a trade recommendation because I'm not supposed to give trade recommendations since I work for the exchange, but looking at VIX around 12 or so, if somebody thought that it was going to stay in that range, they may consider selling now September's the front month, they might consider selling the September 12 straddle and then, buying an upside call just to make sure if we get a volatility event between now and September expiration, they don't get hurt too badly by it, but not necessarily worrying about the downside risk because, I think a lot of VIX traders consider 10 somewhat of a floor, and that's a very unique trade relative to VIX.
Okay. All right, well, thank you, Russell. I guess we can wrap it up there. So, guys, I just want to let you know that this was Russell Rhoads. He is a chartered financial analyst, and he had joined the Options Institute in 2008 over at the Chicago Board of Options Exchange. Russell, thank you very much for your conversation this morning. I really enjoyed it.
Thanks a lot for having me. I appreciate it.